Alrighty, folks, we are talking 2025. We're going to ask some questions of Dustin from Convoy Home Loans, what he might be scared about, nervous about. We're going to hit three topics that are really in his sweet spot. Dustin, how you doing, buddy?
Good. How are you?
I'm doing well. So something I started earlier this week with the one and only Anna Kelly was kind of asking folks what makes them nervous about 2025. So I'm going to hit you with three different topics. You could say things like not concerned at all, very nervous. We'll kind of dig into each of these. You ready to rock and roll?
Yeah, let's do it.
Let's talk about rates. Obviously, you work in the mortgage business, something I have put out there a couple of times now, but I'm going to ask you, how concerned are you, nervous, whatever the right answer is, about possibly mortgage rates, home loans averaging 7% in 2025? How does that feel? How does that hit you?
I guess maybe two-parted for me. Concerned if I'm your average consumer looking to buy their first home, right? I would be very concerned. I think it's a higher than 50% chance that we'll see that in 2025 for a majority of the year. So at least 6 months of the year, we'll be at
Yeah.
7 or 7.1, whatever. Me as a mortgage owner, company owner. I'm not concerned. I like it. I like it the way it is right now. I like the stability, and I like the ability to let the housing market kind of correct itself. And 2025, it's going to be a lot on. The Feds aren't going to control much with rates. We've seen that. If they cut rates, that's not going to do anything to mortgage rates. But if inflation gets under control, we can see rates come back down. But with the new president in office right now, I don't think inflation is going to be something that goes down, especially in the first 3, 6, 12 months that he's in
Yeah.
office.
Yeah, I think the first 6 months of 2025 are particularly interesting. And again, I do think rates are going to be higher for longer. I love how you answered that question because I think most mortgage brokers would say you want 6%. Because what happened at 6%? You actually had a small refi boom there for like 3 or 4 weeks, and
Yeah.
your activity goes up. But to your point, it's probably not a long-term fix. We need to heal the housing market. We actually saw today pending home sales were up, but a lot of that was because those loans were done at 6%, not 7. So I think when you think long-term as an owner of a company, which you do, I think what you're saying is 2025 is going to be a hard year, but you're right-sized for it, so you're ready. But I think 2026 is a pretty good year. It wouldn't shock me if business is up 25% in 2026.
Yeah, I think 2026 is, or anytime after the next year, after the dust kind of settles, after
Right.
all of the enthusiasm about who our new president is and the market and seeing his new policies roll out. But after the dust settles, right, then we'll see really where the economy is. Truly, that's what I believe. I think it's propped up quite a bit right now, and I think 2026 is something that we said 3 years ago. Maybe it's 2024 is the next good year, but we'll keep riding along as long as we keep rates at the 7, 6.5. Convoy's fine, but I don't
Yeah.
think there's anything on the table for your average consumer looking to buy their first home or primary residence that's like showing writing on the wall that we'll get back to 6.599 anytime soon.
Yeah, I agree with that. All right, let's switch gears to topic number 2. One of the things that I have been watching, and I will admit to being a little hopeful for, is the opportunity in the commercial space, specifically some multifamily space. But I'll ask you a bigger question. What do you think the chances are we revisit a banking crisis, a la, First Republic, Silicon Valley Bank, Signature Bank, all of that kind of exploded on the scene. What do you think the chances are we have more bank failures, maybe bank mergers in 2025? Is that a concern?
Yeah, I mean, I would say it's always going to be a concern with the past, let's say 3 years ago to 7 years ago, the loans that people took out on the commercial side, the banks that offer them and the stress tests that they're going through. A lot of it's going to be, of course, on the capital reserves and how much the U.S. banks are willing to help, especially on and we've discussed this, but the balance sheet risk that a lot of these smaller ones have. And I really hope it doesn't happen, right? It's not good for anybody in the commercial or residential industry because there's a lot of small
Hmm.
banks, credit unions, regional banks that play in both. So I'm hoping that's not the case, but it's definitely still on the table.
Yeah, I agree with that. Well, let's ask you one final question. Just generally speaking, 2025. What do you think? It does actually going into a declared recession, is that something that's on the radar, gives you concern, or you don't really think about?
Um, I wouldn't say I don't really think about it, but I think it's something that we have essentially been walking a very thin line and hovering on it, in it, out of it for
Hmm.
the last year, really. So, um, in 2025, I think it's not going to be mentioned just because of who is in office now. I think if we get to 2026 and 2025 is not as well as everybody had hoped, that's a much bigger scare for me. But right now, I would argue that we're in one right now, and we have been for about a year, year and a half. So it's um, maybe
Yeah.
a two-winded answer, but I want to
Yeah.
hear
No, I
your
think
thoughts on that one. Actually, the other
on
two I didn't.
recession.
Yeah,
Yeah. So again, I love to own my mistakes. One of the things I do on this channel is I make lots of calls. I celebrate when I win, and I celebrate when, or I acknowledge when I lose. And I've called a recession a couple of different times, and at least statistically been wrong. Although I have been talking about and still feel like a rolling recession is the right answer, right? Where we have different parts of the economy in and out. It's just not enough to get that negative GDP prints. Um, yeah, so I am extremely nervous about Q1, Q2, 2025. I think if there's any pain, any shock, any collapse in the stock market, it's in the first half. I do think we get better from there. I think generally speaking, 2026 is a good, if not very good year as we start to heal, as we go through that. But you can't heal without pain.
yeah.
So I'm really nervous about Q1, Q2.
You think the markets and even our fun. It's been fun to watch Bitcoin, but I
Yeah.
think we're a little bit over leveraged right now.
Well, I think there. So again, I was burned, crushed by the .com crash. Something I learned after that is there's this thing called the Buffett rule, where basically you take the market cap of the stock market against the U.S.'s GDP, and let's just say we are at the third highest extreme ever.
Yeah.
So yeah, I think you know I talk to stock guys every week, and both of them are telling me that they think 2025 will be a lot like 2022,
Yeah.
which, oh, by the way, was not fun for the stock market. So absolutely. Then going to crypto, I think his name's Mike Novak or Novacek or whatever his name is, big crypto bull.
Yeah.
But he wrote an article or was on CNBC talking about the crypto market and Bitcoin being levered to the gills. I think that is so fascinating that idiots don't understand. In an asset that's traded 24/7, you could be wiped out with
While you're
leverage.
sleeping.
I don't know why people buy that stuff with leverage. I don't understand. I don't get it. It's crazy. But we are going to 100K. I think that's pretty clear in Bitcoin.
Yeah. Pretty wild. Pretty
Pretty
wild.
wild. Pretty
Yeah.
wild. Pretty wild. All right, let's switch gears to the overall market. I don't know what you've seen in your business, but I've talked to real estate agents and landlords, and there's been a dramatic change post-election. Open houses, like pre-election, the last 3 or 4 weeks, their words, not mine, cricket and tumbleweeds. Not a lot of activity. Post-election, open houses up 8, 9, 1,000%. People with vacancies are getting applications now. So I'm curious, what happened in your business now that we're 2 weeks past the election?
It's really funny, and we were kind of discussing this during our like weekly just overview of how the company's numbers are doing, and we had our controller look. And me and John found this really, really interesting. So I wanted to run the numbers specifically from September 1st to October 11th. Okay,
Okay.
October 11th was when job reports came out and basically treasuries went up, 60, 70 basis points overnight, right?
Yeah.
The amount of applications that we got from September to October 11th, and this is just on like an average weekly basis,
Hmm.
compared to uh, November. What day was the election? The 4th,
Sixth, sixth.
6th.
I thought.
Okay, from the 6th to actually yesterday, the 20th, to that 2 weeks
Yep.
after the election,
Mhm.
we saw an increase per week of 16% in terms of applications coming in, when rates were zero point 0.8, zero point 0.9 higher than they were during the time of September, right, 1st to October 11th, which was a bit, mind-boggling, because there were so many people on the sidelines that didn't jump in from September to October 11th because they saw this downward spike, right? And they're like, all right, let's ride this. Let's just
Yeah.
keep riding it. Let's
Six
wait till
six
the
one's
election
not
happens.
enough. Let's go 5.
Yeah.
Yeah.
And then election comes, like, all right, let's do it. Let's, and it's
Let's
a
roll.
fun
Yeah.
mental, psychological, uh, you know,
So let me
thing that I
repeat.
think a lot of people are going through.
I want to repeat what I think you said, because I think you're absolutely right. It's wild. So as rates were in the low 6s, you had a baseline of activity. Let's just call it 100, just so I can do the math in my head. Then you do the math post-election, which, oh, by the way, rates for a lot of people are 1 point higher. The rate is 116%. So you're more active these last 2 weeks at a point higher than you were when you were a point lawyer. Is that what you said?
That's exactly what I said, and that's what drove me like insane, because I was looking at like the amount of applications that were coming through, and I'm like, this is great. How are we so busy? Why are we so busy? Do me a favor and look to see why. But we get a lot of those, applications filled out like urgent, please, I need to get this done. Like, I am in a hard, whatever it may be. But the amount of applications that we saw, from September to October 11th, when rates are at 6, was 16% lower than what it was from November 6th to November 20th yesterday.
Well,
just for our company, this isn't the mortgage industry.
No,
Right? I don't know what the
yeah.
whole industry is,
Yeah.
but just for us.
And frankly, you don't care, and you shouldn't care. Yeah, protect your house. I think that's wild. And again, as somebody who studies consumers, it's actually predictable, because we had a 5-week period, which you measured, the 1st to the 11th, where rates were on a pretty noticeable trend. It was a trend. They were going lower seemingly every day. So human behavior says, I'm going to ride this trend. Fast forward to the next data point, election, day after the election to yesterday. The outcome is known. We have certainty. And generally speaking, there are people like, okay, enough waiting. It's time to go. It's time to roll. It's funny. It's just,
and these are applications, I'll keep in mind, not loans closed, but just applications. Correct. That gauges people's interest that I wanted to test. But
no, I mean, I would have bet money and lost.
Same.
Yeah, I would have lost. I would have lost that bet. Crazy. All right. What would you say the general overview of the market? Where we're at today? Obviously, rates are higher, even though the rate cut again. Fed cut again. What's going on in the market?
Yeah, I mean, look, your average 30-year fixed conventional, primary right now is at 6.93, 6.95. Whatever you want to call 7%. But what I found interesting is right now, I before we got on this show, I priced out just basically a 25% down conventional investment property. Okay. This was for a single family residence. Okay. The average rate from Fannie Freddie products at 7.3. Now, keep in mind that's with no prepay. Okay. But the DSCR loans right now, we always use, let's compare it to a 3-year prepay. DSCR loans are at 6.96. Now, why do I think that's the case? I don't know. I'm waiting to meet with one of our hedge funds that we sell to next week. Me and John are. But you and I, before this video, were like, look, I think Wall Street's a business. They're very good at business. There's only about, 5 weeks left in the year. They might hold things down for the next 5 weeks to get those annual bonuses, and then we'll see them follow what Fannie and Freddie and the Treasuries are doing.
I think there's a lot in that. I mean, it's really wild because, again, we've been doing this show for a couple of years now. Generally speaking, DSCR loans are an eighth to a quarter more expensive.
Yeah.
Now we're talking a quarter to a third less expensive on rates.
That's a lot.
It's a lot. That's a big. That's a half point swing.
That's a big margin right now.
Yeah, it's pretty wild. Well, that's one of the reasons I appreciate Convoy coming home or coming on each and every week. You do have the ability to look at what's the right loan product for the, home buyer, investor. Where do we send them?
You can go to convoyhomeloans.com and make sure you click on that ORAT button so you get me or John.
Yeah, again, folks, if you don't click on that, you just end up in a queue. We are really, really good at what we do. We do not belong in queues. Think of this as your Disney Plus pass to cut the line. You're going to get right in front with Dustin and or Jonathan. Convoyhomeloans.com. Click on the ORAT button. Thanks, buddy.
Thank you.